Thank you, Danny. Welcome, everyone. Good morning. I'm happy to be on this stage with Milwood, Hobbs of Oaktree, Marc, Pinto of Moody's, and Vaillancourt of Voya. We're here to talk about systemic risk and liquidity in private credit, very topical at the moment. Marc, maybe I'll start with you. Like, it feels like, a few years ago, it would have been really hard to find someone even discussing systemic risk around private credit. And the idea was like you were putting, loans that banks used to do into steadier hands, matching long-term assets with long-term liabilities. What do you make of the discussion around sort of these semi-liquid funds, and how are you thinking about systemic risk?
Yeah, I would say for sure private credit has become more systemically important, right? I think that's, a decade or two ago, it was really on the periphery. We used to call it shadow banking. It's all grown up, it's called private credit now. So it is more systemically important, and it's changing a lot as well. I mean, it's something that you really have to stay on top of. It started out being middle market lending, and it's really become more global in nature. It's moved to asset-based finance, is something we talk about a lot today. And to the point that Brad made at the very end there, the credit spectrum has also widened. Whereas it was largely speculative grade type lending, you're also seeing investment grade type lending. So there's a lot happening. It is more systemically important, and that makes it important for us to focus on.
I want to come back to the asset-backed finance piece as well, but Milwood, maybe just to get your perspective as someone who's actually putting money to work. How does liquidity and having to create some liquidity for retail investors affect your process? Because that, as we were just hearing in the prior panel, can create issues when the money's coming in too fast or when it's going out too fast.
Right. Well, look, thanks for having me. I think it's important to recognize, and I think the last panel said this, that the funds are structurally set up to invest in private illiquid assets, right? And the footnotes say we can redeem up to 5% of NAV on a quarterly basis. And so the way we manage through that is we have liquidity facilities, we have public securities that we can sell to manage that. But really, if you think about beyond the 5%, I'm either going to sell assets, right, or take liquidity for the other folks who stay in the fund. So I think what everyone's trying to sort of figure out is what's the sort of, when the noise sort of stops, what sort of baseline redemptions could be. And if you go back to 16 or 2020 or even Q1 of 23, 40 days in COVID, the best sort of returns in the space was during the volatility and dislocation. So I think if you're actually trying to sort of generate returns for investors, someplace like Oaktree, that's when we sort of invest more, right? We kind of underinvest in benign markets, and we invest more in volatile markets.
And Amy, Voya has a partnership with Blue Owl, and the point of that effort is to bring private markets to the retirement community.
That's right.
How are you thinking about that, and particularly with all the concerns that we've seen and the pressure we've seen on BDCs, for example, in recent months? Has sort of your thinking about that shifted in any way?
No, I mean, it continues to be important to us and important to our clients, the advisors that we work with, to be able to have diversification for plan participants and for the employers that manage those plans. And so that continues to be very, very important. I think one of the things that we're learning and working through together with our partners and other partners in this space is really to be able to understand, we guide ourselves on two things. One is education, heard that a lot in the last panel. I don't think it can be said enough. And the second is really around professional management. So when we think about these inside of a retirement plan, we really think of them really only right now in the context of professional management. So think of an advisor managed account or a target date fund, not, and one of the things we had talked about a little bit earlier was was not having that investment option available to that individual participant directly to make some of those decisions, so that the investment manager are actually professionally managing that, and then considering the size of the allocation as well as the liquidity.
Marc, how far do you think we are from a point where liquidity pressures on redemptions, even if they are investors acting out of fear and maybe the fundamentals don't justify that, but do snowball into any credit issues?
It's an important thing to look at. You know, we've been emphasizing as well that this is a liquidity issue today, but a prolonged liquidity issue can turn into a credit issue. And I think you heard from some of the panelists just before us that they're thinking very carefully about liquidity. And in fact, the more liquidity you hold in the fund could very easily impact the overall return that you provide to investors. So this is about confidence, trust, education. We had been saying for some time, and in our private credit outlook that we put out last month, that as you bring more private individuals into the private credit ecosystem, it potentially raises risk. And if the private investor is not receiving what it believes it was promised, then you end up with a confidence issue. And while there was a lot of very logical discussions just previously and about what's going on in this market, the investor base has been spooked, and billions of dollars in market cap have been lost, and it's important to focus on that. Again, it's educating the market about what's going on here, and emphasizing the structural features of this market and the fact that the market is operating rationally at this point in time.
And Milwood, talking about sort of credit issues, we definitely have had some accidents along the way. Banks have had them, private credit funds have had them. I think no one is immune to that.
Right.
But when you see, there's been a lot of concern around valuations, for example, in private credit, and you see loans that drop from 100 to 0 in a very short period of time. What does that tell you about the underwriting environment, and could you help us size that?
So look, I think it's important for everyone to appreciate that private credit is a subset of leveraged credit in totality. And what you see is, in the public markets, what you see is, generally speaking, it's a liquidity issue and not a credit issue. So when you think about the AI and software, and loans went from roughly par to on average 92 in software, it's not that the software names are now worth 92. It goes to a level where there's someone willing to buy the risk, which is not necessarily driven by the credit. And I think it's important for everyone to appreciate that markets move based on capital, right? So we've been in a market the last few years where capital was more than the opportunity set. And so when capital is more than an opportunity set, you tend to price capital versus the underlying risk. And so that's the challenge that we've had in the markets, generally speaking. Now you have psychology, right? And so at some level, what drives movement in that credit is the psychology aspect of it. And I think that's what we're dealing with. And that's going to take some time. But what I think happens over time is that if you're sort of like patient, right? If you're patient, I think you will see most of the credit issues will be solved. We will have higher defaults, that's clear. Like, everyone in our market's been a genius since 2010. There's been no one that's dumb. So we will have some issues. And I think the other thing you will find is that we'll have some opportunities, right? Because now with the outflows, we have to reprice our capital because we're not getting the inflows. So we have to be more selective. So asset selection becomes more critical. And we're going to reprice capital based on the fact that there's less capital now relative to the opportunity set. So I think that's
bringing
good.
some discipline.
That's bringing discipline, that's good. The underlying all of this is we've had interest rates at 5% or elevated levels for some period of time. And interest rates are kind of like, I think of it like rainfall. If it rains every day, all day, but you can kind of get in and out of your car, get in and out of the office, after 2 or 3 years, sinkholes develop, trees fall down, mudslides. And so I think what you're seeing overall in the market is that the interest rate being high is sort of impacting what I think could be the macro. And if you were a capital structure that was done in 21 and 22 ahead of rate increases, at some level you're over-levered on a cash flow basis because no one predicted rates would go from 0 to 5%. So it's not like the diligence process has changed. It's not like we're sort of like, oh my God, we have to do this deal. The higher interest rates are constraining cash flows, right? Tariffs are constraining companies' ability to actually earn profits. So there are real things out there that are driving this versus, some of the things we're talking about here.
Yeah. And Marc, maybe briefly to come back to you, are there specific credit concerns that you have at the moment in terms of the underwriting environment?
I'm a rating agency analyst, so I'm concerned about everything all the time.
It's glass half empty, guys.
Classic credit.
Exactly. No, I mean, we actually are pretty constructive on the market overall. We see rates potentially moving down a little bit to solve some of the issues that Milwood just brought up. We see the economy ticking along, not super strong growth, but decent. I would say the economy is pretty resilient. I've been plenty of conferences like this, and the word resiliency has really stood out to me. Currently, if we look at our global high yield default rate, it's about 5% today, and we expect that to go to about 3% by the end of the year. So that's a pretty constructive view for the market. We do look at concentration risks. Certainly, the greater focus on software and technology companies is something that we're looking at very carefully, but we also look at, what does a software company, what are they providing? Are they an embedded and an important aspect to a company's operation, or is it just maybe some sort of an interface? So there are, and then also how the loan is underwritten, right? What kind of collateral you have, what kind of contracts do you have? So there's a lot of complexity to looking at that market today, but I would say overall we're pretty constructive.
Yeah, on the marks, by the way, so, I think that's a good, we should talk briefly about it. So the marks in private credit are twofold. Number one is just movement and spreads,
Sure.
which is the science of a mark, right? Then the other aspect of the mark is the valuation of the business. And so what we don't mark to in private credit is a fire sale of an asset when you need to raise liquidity. No one marks, we don't mark to that. And so I think we are all conscious around marks. These are vehicles where the retail investor has a lot of oversight from the government. I think none of us want to be perceived as mismarking names. So I think we spend a lot of time on marks, but we don't mark for selling it on a Monday when the market's closed and we have to have the money by Tuesday.
Right.
We don't mark for that.
And actually, I wanted to bring Amy into this conversation because obviously when you think about retirement plans, we all have them, the instinct of a retail investor when market is down is go check where the retirement pot is marked at. How do you solve for that with private markets, right? These are assets that can be hard to value. How do you give investors comfort that the number that they're seeing on the screen is kind of the true value of the underlying assets?
Yeah, so it's not unfamiliar in retirement plans to have certain assets that have different valuations. And so as retirement providers, we have the capabilities of doing that. I often quote that people have pieces of art in their 401ks sometimes. And so the valuation piece is just something that we work with, we'll continue to work with the private asset managers to make sure that we have that. And then that'll be the beauty of the retirement provider is that we really are that window to that plan participant to see the information. And so you'll see that, they'll be able to access that digitally on their statements and things like that. So really practical pieces that you do with respect to things like valuation. And then as it relates to the volatility part, one, I'll go back to education and I'll go back to professional management. Those two things really guide all of our thinking with respect to these types of investments, and we share that with employers. Advisors are very engaged in this, and through advisor managed accounts, they'll actually be managing that, right? That's their job, is to manage that volatility. I'll just add though that from an industry perspective, from a media perspective, from an employer perspective, family member perspective, people do not react like they used to react with these peaks of volatility. We have, we call it stay the course or stick to your plan. And so we actually, in aggregate, watch the behavior of the millions of participants that we have. And in these spikes of volatility, 98 to 99% of them do not do hectic transfers and asset reallocations. And so it's a little bit of a success story for the industry and for many of you who've been involved in that, to be able to carry that message. And so we expect, with a combination of professional management, the education, and the history of, the education around stay the course, that will continue.
Do you think like a lot of the volatility we've seen recently in the redemptions is mostly coming from what people call the wealth channel, right? Which is not quite as retail as retirement, 401ks. Do you think education is obviously a big part of this, but something went wrong in the communication with those type of investors?
With the retail investors.
Yeah, I guess.
Yeah, I think we all kind of have, I think every single person on the stage before and now has indicated that the clarity of the message, disclosure, and education is very important. I just keep going back to the same place around professional management, which puts a layer between that individual having to think about doing that versus someone is managing that for them right now.
And Davide, I talked a little bit about how the lending has changed, the investor base has changed. So Brad talked about how they've had retail investors involved in their products for many, many years. But there's been a lot more retail investors coming into this market, and they're different. They're not all super high net worth individuals. If you were in a product years ago, you had to have $1 million or $5 million or $10 million. Your money was locked up for 10 years with maybe two years extensions. You'd say goodbye to your money, $1 million or more, for 14 years potentially. Yeah. Today, you can get into a private credit fund for $2,500, and you're told, well, they're at the discretion of the board. You need to read the fine print. 5% of the assets can be called or can be redeemed once a quarter. I think some of that got lost with the new entrants. And so I think what you're seeing today is a manifestation of the challenges of bringing a wider swath of the retail investment community into this market, which again, you've heard it before, it's got certain features around illiquidity. People understand the illiquidity of buying a house. That's got a certain amount of liquidity to it, right? Buying a car, that's got a different amount of liquidity. Buying something on Amazon, that's got a different amount of liquidity. So you need to think about if I'm buying in and out on the stock market, or I'm trading treasury bonds, or if I'm in a private credit fund. That I don't think has sunk into the mentality of the newer investors. And I think
would
that's
add
what we're
to
focusing
that,
on, right?
in the context of the retirement plan, so if you think of the target date, or if you think of like a single strategy or multi-strategy private asset CIT, the allocation, so if you think about that in the context of the target date, I mean, generally the products that we're starting to see come out probably have 10% or less in that sleeve. And so you have that 90% wrapper of liquidity. And then when you think of the more single strategy type, we're really, each product or each solution has its own requirements. I would say we're starting to see about 15% become a little bit of the norm with respect to a liquidity buffer that sits right within that CIT. that helps when someone wants to take a loan from their 401k or needs to take a hardship, that access is able to be there. It still has to be managed. It's being managed at the RIA level, but it actually gives some, I would say, some help with respect to that.
Sure.
We only have about 5 minutes left, but I did want to touch on asset-backed finance. Milwood, maybe I'll start with you, but obviously that is an area that a lot of people are excited about, sort of a new frontier in private credit.
Yeah.
A lot of it is considered higher quality. How interested are you in that space? And I can't help but notice that it's also a space that has created a lot of trouble if you think about First Brands and Tricolor.
Sure. So I was at GE Capital in 1997. So I did ABF in 1997. So ABF is not new, right? What's happened is the banks have to shrink their balance sheet. And one way to do that is they just do less warehousing of assets and then securitize them. So it's not really new. It's just been a shift from the banks to private credit. I think ABF is very interesting. I think it's also not that easy, right? So when you think about ABF, you've got an asset. It has contracted cash flows. Those cash flows are driven by the revenue of that asset daily and the utilization of that asset. So as long as the economy sort of stays steady state, that's great, right? If you have the economy become a little bit more choppy, what happens is utilization goes down. And to keep utilization from falling off a cliff, you lower revenue, right? And so when you do that, the asset doesn't generate the cash relative to the debt that's been put on it. So I think it requires professional management, right? And then I think it also requires education. But I do think there's opportunities for private credit to grow that space because I think the banks have realized deposits are not that sticky. And when you have a situation where you make loans based on deposits, you've got to pick your spots where you can actually lend. And so ABF is just shrinking on the bank side.
And Marc, ratings are obviously a key component of structured finance.
Yep.
Insurance is a natural buyer base for a lot of that product. I think there are concerns around that idea. Colm Kelleher at UBS has talked about, systemic risk coming from U.S. insurers' investments in private credit. A lot of those ratings are private. He's talked about the danger of ratings arbitrage. How are you thinking about those issues?
Yeah, so there's much greater interconnectivity today than there's ever been between the insurance companies, the banks, the asset managers. We've never lived through a period of time exactly like this. But I would say with respect to the insurance companies who've been very big buyers of private credit, this is not their first time at the rodeo. They were there when railroads were being built in the Industrial Revolution. The Empire State Building down the street, which was conceived in 1929, just before the crash, had a bunch of banks lined up to finance it. They left. The insurance companies came in and helped to finance the building of the Empire State Building. So they understand this. They have been increasing their asset risks. They've been increasing their illiquidity in their general accounts, but they've also been reducing their liability risk by selling off some tail business that is a bit riskier. They're sharing some of the risk with their policy holders. So it's very interesting. In the banking community, we're seeing asset risk come down in the banks. We're seeing liability risk rise because we can use our phones to move money around. We saw that with Silicon Valley Bank. And in the insurance industry, asset risk is rising to some extent, but liability risk is coming down. And I would say the last thing about the insurance companies who've been fueling a lot of this growth, they've been very good and have held to their tenets of asset liability management. They have policyholders that are living longer, they need duration, they need diversification, and they need higher yield. And they're getting that in the private credit space because they can't get it in other places.
Yeah. Okay, 40 seconds. Amy, in terms of going up in quality, is investment grade private credit an area that you think could fit within the scope of your effort in private markets?
You know, we really don't have just a limitation with respect to private credit. It's really all private asset classes that we're actually looking at and working with providers to be able to offer diversification. I mean, it comes even within the classification of private assets, there's diversification. And so it really is an intention to explore all of that and offer those opportunities for employers.
Right. Please join me in thanking our panelists, Amy, Marc, and Milwood. Thank you very much for being with us.